You have two possible outcomes: higher than expected inflation or more than expected tightening. And the amount of each you get is going to depend on exactly what the Fed does, so we're positioning for both. Can you comment on the first piece of that we have these two possible outcomes? Do you agree?
I sort of do, but, to me, my broader concern is that the kind of inflation we're seeing right now, things with like labor shortages leading to higher wages, as well as, concerns in like owner's equivalent rent. We got that on Wednesday, continues to be rising. So these sources of inflation are likely to be much more persistent. And I'm not sure if raising rates aggressively is going to be able to address these sources of inflation. Yes, the Fed can have an impact on the interest rate sensitive sectors of the economy, housing, for instance, things like auto loans and things like that. But beyond that, there's not really anything they can directly do to impact, labor shortages as well as even supply chain disruptions for that matter. So I think that the Fed is going to be somewhat cautious in its approach to raising rates, given the fact that, raising rates might have unintended consequences for other parts of the economy while they're on their way to try to address the inflation issue, broadly speaking.
Matt Hornbach, I'd love your reaction to that as well. You have two possible outcomes: higher than expected inflation or more than expected tightening. Are we just down to two outcomes?
Well, John, I think what the Fed can influence is how financial markets behave, and ultimately how financial markets behave can affect consumer behavior through the wealth effect. So ultimately, raising rates is not going to fix inflation from the supply side. It can fix inflation dynamics, however, through demand. And so ultimately, look, if markets are discounting almost 4 interest rate hikes this year, and the S&P 500 is barely 2.5% off its all-time high, then that would suggest that if inflation remains high after supply chains have fixed themselves, then the Fed is going to have to do more to try to reduce the degree of demand that comes through the economy, which ultimately may end up keeping inflation elevated, and therefore they will have to hike faster in order to have financial conditions tighten more than they've tightened already.
Richard Bernstein, how do you position for both higher than expected inflation or more than expected tightening?
So, Jonathan, we're taking the over on inflation, right? We're thinking of it as an over-under bet. And I think the lesson of Paul Volcker was that it's very difficult to stymie inflation without a recession. And I don't think that this Fed has the backbone to force a recession. I don't think that's in their game plan. So I think what you want to do, if you agree with us and you want to take the over, again, you're looking at pricing power. You want companies that have immense pricing power. That's not growth stocks. That's traditional cyclicals, things like that. I mean, if you think about the energy sector, for example, the energy sector, the infrastructure build in the energy sector is woefully small relative to the price of oil. And inventories are very low. That argues you're going to get more pricing power. If production isn't ramping up tremendously, inventories are low, demand isn't going to be stymied, that argues you're going to get higher prices. I think that's just one example of what you're seeing in many cyclical industries.